Second quarter growth rates jumping to 8.2% for 2026. The Indian economy has set its eyes on 2026 with one hope: the year of revival. While top economists and rating agencies are pegging India's growth at around 6.7%, RBI is bullish on the Indian economy, with a mega projection of 7.3% after the Q2 numbers. With consumer price inflation easing in 2025 to just 2.3% as compared to the 4.9% last year, it's the Indian consumers that are driving the Indian economy's growth engine since the GST Bonanza announced ahead of Navratri in 2025. This, combined with the front-loaded policy rate cuts and liquidity injections, along with income tax rate cuts, the Indian economy is set for revival, even in the face of adverse tariffs policy.
The primary sector of growth in which India is looking forward is to the manufacturing. But besides, service sector continues to dominate the economic growth of India. I believe the way the investments are flowing in India, the way economy is projected to grow, and employment which we are looking forward to, manufacturing sector should be predominant in terms of growth numbers, but overall service sector will still continue to dominate.
So as far as the primary drivers are concerned, the first thing that everyone needs to understand is that growth is being driven essentially by consumption of the high-end consumers, meaning the top 10-15% of the population, and not by investment, which is a problem. So the risk factor is obviously built in there. But talking about high-end consumption, that's going to drive to some extent growth. But for that reason, because high-end consumers account for only 10-15% of total consumers, there's a limit to how much they can drive growth.
However, the dollar question still looms for Bharat in 2026. The Indian rupee slid to around 89.85 against the US dollar by late December of 2025, marking an annual decline of nearly 5% amid a widening currency gap. As projections show, this gap can further widen to 90.58 rupees by September of 2026.
That is a matter of concern that Indian rupee is depreciating against the US dollar, and the demand of the US dollar increasing is a matter of concern looking to these economic parameters. So this will be one of the major issue to be dealt with in the budget 2026. How do we shape the economy so that the pressure on the dollar Indian rupee is not to that extent as it has happened in the year 2025.
You see, globally the dollar has weakened, but it's just against the Indian rupee that it appears to be strong. So the Indian rupee has weakened, and the rupee is now over 90 rupees per dollar. So we've got to look at not what happens to the US dollar, but more to how the rupee is behaving relative to the US dollar. So that's going to obviously mean that because the rupee is weaker, there's an opportunity for us to increase our exports. But, we've got to make sure that we are prepared to actually take advantage of the weaker rupee.
While the RBI is taking measures including dollar sales and government security purchases worth rupees 11.6 billion and a buy-sell currency swap of dollar and rupee upwards of $10 billion in early 2026, all eyes are on whether injecting liquidity and currency management can prevent the dollar to breach the 91 rupee mark. However, it's not just the monetary policy that will sail the boat of growth in 2026. On 1st February, Union Finance Minister Nirmala Sitharaman will return with her 9th consecutive budget for the Indian Republic, a record no other finance minister has held in Indian history.
These reforms have been carried out with a focus on the common man. Every tax levied on common man's daily use items have gone through a rigorous looking into, and in most cases the rates have come down drastically.
With India's gross GST collections for the month of November at around 1,70,276 crore, up by 0.7% year-on-year on the back of the GST Bonanza, Finance Minister will have a war chest unlike any before despite lower GST rates thanks to increased compliance. While India's trade deficit has increased significantly in April and October of 2025, reaching nearly $196.82 billion due to the tariffs pressure, exports too fell in October by 12%, while imports increased 16% year-on-year. In the interim, India's foreign exchange reserves have stood robust at around $693.32 billion. The trade challenge for the economy, however, remains crucial. Amidst this, the FY27 budget is expected to play a pivotal role in reinforcing India's economic expansion, with key focus on nurturing domestic demand.
We see that two major reforms have been carried out. One was the direct tax, where we had a new income tax act and concession which has been given in the corporate tax, and then later on the personal taxation where income up to rupees 12 lakh has been exempted. Corporate tax are reasonably 22% plus surcharge. And then with GST, we made a mega changes in the month of September. But now what we are in an area which is left with the customs, where I believe there some duties are to be rationalized. And these provisions of the customs which facilitate the ease of doing business. One area which I will prefer and I think the government should focus is third country import and export.
The primary focus is expected to remain on public CapEx, particularly in roads, highways, railways and urban development. The new Income Tax Act is further expected to boost compliance. Industry experts expect incentives for renewable energy, electric vehicles, battery storage systems and nuclear energy sector. While MSMEs hope for stabilization packages, enhanced credit guarantee schemes and export incentives to navigate global trade uncertainties. However, it's not just the handouts that can salvage the situation. It's the deals that India can ink to turn around the landscape. And that is where India's trade policy takes front seat in 2026 yet again.
It's also our third FTA with a Five Eyes nation, Australia, UK and now New Zealand. We are soon going to launch discussions for the terms of reference with Canada also. And we are already at an advanced stage in our discussions with the USA.
With FTAs with the United Kingdom, the EFTA trade bloc, Oman and New Zealand signed or concluded in 2025. All eyes are now on 2026 and whether we can do the deal with the US and the EU.
So I'm doing a trade deal with India and I have great respect and love. As you know, for Prime Minister Modi, we have a great relationship.
While the fall of 2025 deadline has yielded no result, after 6 rounds of talks, The US trade representative is expected to resume talks in January with India after the holidays and after nearly a year-long tango for an interim trade agreement.
We were being told earlier in the year that by September of this year, an India-USA trade deal would have been signed. That's not meant to be a free trade agreement, it's a trade deal. So that would have been signed. We are at the end of the calendar year, we are nowhere close to a trade deal with the United States. Now, if India actually begins to give in on agri-tariffs with the EU, which it had sort of begun to do in respect of cotton with the United States, then, the government can expect a very severe backlash from India's farmers.
The world of tariffs is also going to keep changing, I think, in 2026 and in 2027. But for India, I think the way we have navigated in 2025, there have been several positives, especially the fact that we have not given our position up on agriculture imports into the country. We have to protect the farmers. There is no doubt about it. And why do we have to protect the farmers? It's not because they are weak. It's not because they are not competitive. It's because our regulations in the agriculture sector make our farming uncompetitive.
Meanwhile, on the European Union front, the ministry says that the talks are at an advanced stage, committed to an early conclusion.
Our friend Marosh and I are leaving no stone unturned to get some good outcomes. We just had very extensive engagements on Monday and Tuesday earlier this week. Given the political guidance and leadership of member states such as yourself, given Prime Minister Narendra Modi's own personal commitment to the EU-India partnership, I do believe we should be able to get this over the finishing line.
Trade deal with EU is very promising. It opens up a lot of markets for us. In fact, if we look at some of the analysis done by the Economist magazine, 4 or 5 of the fastest growing economies in the world are currently actually in the EU, because when you look at countries like Poland, Estonia, Uruguay, these countries are actually growing very fast. And even when you look at the Scandinavian countries, they might not offer a big market in terms of population, but in terms of purchasing power, these markets are extremely big. So even today, the EU markets are very, very attractive.
As India races to 2026, the numbers tell a story of roaring growth and rising risks. A booming GDP, but a bruised rupee. Record GST, but a high trade deficit that refuses to blink. Now it all comes down to the fine print. Will the budget of 2026 and the next wave of trade deals turn this year of revival into a decade of resilience? Or will India's growth story be held hostage to a slipping currency in a hostile global marketplace? The countdown has begun, and the world is watching which way Bharat bets.